Hi guys, welcome back. Today's topic is the simplest and most efficient investment strategy to supplement your retirement income. Giving you the conclusion first. Buy index fund for your retirement life. It's simple and easy and most of all guarantee stable profit. Here is my rationale to support the statement. Eugene Farmer, the Nobel Prize winner in economics, claimed an efficient market hypothesis in his thesis. Summarizing this, asset prices reflect all available information. There is an interesting test that explains this well. Fill the glass bottle with jelly and ask people to guess how many jelly inside. People guess from 400 to 5,000. However, the average value of all participants' guesses was almost close to the number of jelly in the glass. In this context, he insisted that asset prices reflect all available information. This is why index fund is valuable. Before discussing index fund, first thing first, let's be clear on two terminologies. Index fund. An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a financial market index, such as S&P 500 index. ETF, an exchange-traded fund, is an investment fund traded on stock exchanges. In this video, I will call it ETF for both. ETF has thousands of products depending on their tracking index. For example, stocks, bonds, commodities, real estate, regions, industries, worlds, countries, sectors. These are all you can invest through ETF. The major benefits of investing in ETFs are you can buy all of the nation's stocks only with $100 or even less. Second, you can buy it at very low cost. The screen you see now compares the fees between Vanguard funds and its equivalent funds. The difference is up to 20 times. Most Vanguard's ETF has cost below 0.5%. Of course, some are more than that, especially for ETFs that follow very small indices. They may exceed 1%. But these types of ETFs are against the philosophy of ETFs in my mind, so I consider them as exceptional. Vanguard, BlackRock's iShares, and DFA are the world's most famous index fund providers. Today, we will focus on Vanguard. Let me tell you why Vanguard. First, Vanguard is the founder of the index fund. In 1975, when John Bogle created the world's first index fund, he said, don't try to beat the market, but buy the entire market. The Vanguard 500 has an annual return of 10.72% for 43 years. That being said, every 7 years the principal doubled, or if you had invested for 43 years, your principal became 80 times. Warren Buffett mentioned Vanguard fund in a big way. Specifically, he recommended that 90% of cash left to his wife be invested in Vanguard S&P 5 index fund. Then let's find out who is Vanguard. Vanguard is a US company, operates about $5 trillion. And also, Vanguard is the second largest ETF providers in the world. Now let me introduce two Vanguard ETFs that I'm confident that no one will challenge me. The Total Stock Market ETF and the Total Bond Market ETF. They invest in all stocks worldwide and in all bonds around the world respectively. The table looks a bit complicated, but follow me, you will understand. Expense ratio 0.03% and 0.04%. Very, very low. 3-year performance 9% and 5%. The volatility, obviously stock ETF is higher. Beta. Beta is a measure of the volatility or systematic risk of a security or a portfolio compared to the market as a whole. 1 means it moves as the whole market. Both ETF is more or less 1. Sharp. Sharp measures risk-adjusted performance. Is calculated by subtracting the risk-free rate of return, which is US T-bond, from the rate of return for an investment. No doubt, stock ETF is more risky. No need to look at all of this to select ETF. I personally choose an ETF with 3 considerations. First, providers. I choose among 3 companies, Vanguard, DFA, iShares. Second, performance of index fund. Third and the last, beta. It should equal to 1. Now, I will tell you a good strategy. First, let's look at the chart together. The chart you see now shows the S&P 500 index and the 10-year T-bond price trend from 2014 to 2019. For your information, a T-bond is a bond issued by the US Treasury, and this is the one considered as a risk-free instrument. As you can see, when the stock goes up, the bonds goes down. Vice versa. When the bonds goes up, the stock goes down. Stocks and bonds have a low correlation, but both are upwards in the long run. They are perfect combination. Wrap up in 3 lines. Buy global stock ETF and the global bond ETF together. Buy the same amount every month. Mission completed to supplement your retirement income. Next time I will tell you the simplest and most efficient way to invest the 2 ETF in Singapore. That's about it. Hopefully you enjoyed. Thanks for watching. Catch you guys in the next one.